Good morning, everyone. My name is Paul Young. I'm just going to walk you through corporate profits. Now, most of the stats you'll see here will be both Canada and the US, but I will talk about worldwide pressure that will impact on corporate profits. Now, this is only one perspective on corporate profits. You're more than welcome to go out to SCC Sites to kind of look at annual reports to get an idea what's going on with those corporations in terms of sales revenue, cost and profits to get an idea, as well as look at your pension funds or market returns as well to kind of get a perspective of what's going on in the market. Here's a little bit brief bio about myself. I'm a CPA, CGA by trade. I've got 25 years experience in academia, industry, as well as financial solutions. I have my own YouTube channel, which basically I emphasize everything from financial solutions to industry or academic analysis, including government policy. Now I'm going to talk about sluggish growth. I'll talk a bit about corporate profits, what they are. I'll talk about market returns. I'll talk about one group that's looking at in terms of the change in corporate profits for specific countries. I'll get into some specific trends in Canada in terms of corporate profits, and I'll get into a little bit of the US issues, and I'll also bring in pension issues because pensions typically invest in the market, and those markets are typically corporation profits and returns. Now, despite what everybody says, we're in a period of sluggish growth, and these numbers do not lie. If you look at on average for the next 2 years, worldwide, we're seeing 3% to 3.5% growth. But if you look specifically in countries like Canada and the US, you're seeing marginal growth at best from 1.6% up to 2.2%. And in the Eurozone, you're seeing struggles to get above 2%. So we're not seeing significant improvements in the economies. In most cases, when you look at an economy in general, it's driven by consumer spending. So if consumers aren't spending money, that money's not circulating in the economy, that means basically the need for goods and services isn't as required or isn't as demand. Plus, companies are watching the bottom line, so they want to make sure that with what they do in terms of investment, there's a return and it's maximizing their profits. Corporate profits, typically you have revenue, you have expenses. After that is your net income. That net income can be then redistributed as retained earnings, as retained by the business, or it can be paid out as dividends. So what you're going to look at in terms of companies, who's been paying a solid dividend yield over those years, and that tells you a healthy financial position. But a lot of cases what you want to look at is just how they're positioning themselves both on a revenue perspective and a cost side, and how their market is responding to the worldwide pressures. Now this gives you an idea of the year-over-year to date trends in the marketplace. Now this looks at the major exchanges across the world, and if you look at things in terms of year to date, we've only got one typically or three funds or markets that are actually doing well. Standard & Poor's or TSX is doing the best, but if you look at in general, the rest of the markets are down significantly from this year as well. When you look over the previous year, some of the markets like the TSX is actually down from the previous year, because if you look at it, the TSX has got a lot of industry in terms of mining and oil and energy stocks, and that sector's taken a hit. And same with Dow Jones. But if you look at NASDAQ, which is more of an IT area, it's actually up compared to where we were in 2015. Same with the Nikkei. You're seeing some upticks. So you're seeing some strongs, but the key aspect is look at the returns. Now the returns themselves in the market, and this is how pension funds are evaluated, are anywhere from 5.5% to 9.1%. That's the returns what the market's giving you. So if somebody's telling you they're giving you an investment of 10% or above, then you need to question that. This gives you an idea on corporate profit trends. The U.S. is struggling to get about 3% growth in corporate profits per year growth. Japan, Germany, and the UK are all growing at about the same pace. But the interesting one is looking at Canada in terms of its growth. That's interesting because Canada's economy is driven a lot by resources. To see significant growth kind of makes you wonder in terms of where that growth is coming from. It's likely coming from key sectors like food processing, forestry, probably clean technology, certain sectors that are growing compared to other sectors. This gives you an idea in terms of the fiscal monitor is a report generated by the federal government in Canada. It gives you an idea where their revenue are coming in. So when they look at corporate taxes, they're actually seeing for up from April to their fiscal year to February, their corporate tax profits. So the money they're collecting from corporate taxes is up 3.5%. That shows healthy profits because the income tax rates at the federal level haven't been hiked. So that's looking at a pure rate in terms of the growth. So profits are pretty healthy in Canada. And that's why I put a bunch of key sectors down there, which basically are automotive, food processing, forestry. US now is a very interesting thing. One thing is they got some of the highest corporate tax rates in the world. The other aspect that you're seeing here is we've seen sluggish growth, and that's impacting these corporations. So we've seen for the last few quarters significant decline in the overall corporate profits. Now that impacts valuation. It's something to bear in mind. That's significant. So in other words, these companies are having a hard time dealing with slow periods of growth. Their customers are not buying as much. If anything, they're scaling back. There could be a buildup of business inventory, which means they don't require as much new goods or services as part of their managing their business cycle. And that all ties back to what I said earlier. We're in a period of sluggish economic growth. So the last thing you do to an economy across the world is do shock and awe to it, which means is you don't bring in bad policies. And that's what the next slide will get into, because that impacts these corporations' ability to compete. I brought in pensions because not enough is said about pensions. I picked on the U.S. from this, a particular pension fund, the Central State Pension Fund. I also looked at the CNBC's report that looks at states, cities, and municipalities. That's in general can be applied to Canada or other countries because there's significant amount shortfalls. Okay, because remember when these pension funds were created to contribute, there was more people entering it. Now you have more retirees drawing from that pension. That means there's going to be pressure on that pension. And most pension plans themselves are defined benefit, which means a guaranteed benefit. What's that mean in general? What that means is likely down the road you're going to see pressure on plans to scale back what they pay out to retirees. And that's something to bear in mind as you're doing your planning of your forecasting in terms of your retirement, because these pension funds have to be solvent, and that's something to bear in mind. CFIB, which is Canadian Federation Independent, did their own survey, and they basically have said that public sector pension funds are underfunded to in excess of $300 billion. Who's on the hook for that? That's the taxpayers, and that's something you need to bear in mind when you look at this. Corporate tax business issues. Now, there's a big plan in play where 31 countries are working together to look at transfer pricing rules. That will impact the taxation rules. That will impact the overall net income. That will impact overvaluations of companies. A lot of countries are reforming their income tax act. The U.S. is one of the countries that has a 39% federal rate. They are looking at reforms because their income tax act is very complicated, and it's all part of this tax avoidance, all part of taking some more tax money in. Again, the more tax money you collect, the lower the profits are. Hydro rights. Most countries are now going on a pro-UN Agenda 21, which is focusing on wind, solar, or renewable sources. Those tend to be cost more. That cost adds to a cost of business. That reduces profits. Any new taxation policies, whether that's a provincial pension plan or a cap and trade system, will impact businesses. So the reason why I illustrated that is to kind of give you an idea of how these costs will impact profitability and what it will do to in terms of businesses, how they realign them, because their sales can only grow at a certain pace. The next thing that they'll attack is their cost structures, and they can maybe only get so much of the supply chain, and it comes down to headcount, and it comes down to other decisions of selling off businesses to maximize returns. So critical decisions will likely be made as business move forward to deal with the sluggish economic growth. Thank you.